I'm Matt Bichard here at the La Quinta Resort and Club in Palm Springs, California for REITWise 2017, NAREIT's Law, Accounting, and Finance Conference. Joining me today for a REIT tax primer is Ken Betts, partner with Winston and Strawn. Ken, thanks so much for joining us today.
Good to be here, Matt. Thank you.
Now, REITs, like any investment, have certain rules that they must follow, and it's important for investors to have a basic understanding of them. From a tax perspective, what is the core takeaway an investor should have?
Well, I think it's important to recognize that REITs have sort of two sets of tests they have to meet. They first have to meet the asset test, and then they have to meet the income test. The asset test requires a REIT to have at least 75% of its assets consisting of real estate, loans secured by real estate, securities issued by other REITs, and debt securities that are issued by public REITs. The asset tests are critical to be met, and they're judged on a quarterly basis. The REITs can also own another 25% of the assets. Typically, they are similar in structure. The Internal Revenue Code has a very, very fine and distinct set of rules. There are two income tests REITs have to meet. First is 75% test. That means that 75% of the REIT's income needs to be derived from rents from real property, interest on loans secured by real property, or other sorts of dividends on REIT stocks and that nature. And then the other element, there's another 20% or 95% in total the REITs have to have, and that would include the 75 income derived from the same sorts of income derived from the 75% test, and then other securities, whether they're equity or debt securities, that are also designated by the IRS.
And what about specific shareholder rules that REITs must follow?
A REIT needs to have 100 or more shareholders, beneficial owners of their stock, 335 days of each tax year. And so REITs will typically send out various forms to their stockholders to make sure they have the right beneficial ownership, and that's the first test. The other test is REITs cannot be what they call closely held. That means that 5 or fewer holders cannot own more than 50% of the value of the outstanding REIT stock. Now, what's interesting is that there are attribution or pass-through rules. So a number of entities that own stock in a REIT, what the code will do is actually look through those entities to the beneficial owners of that entity's stock to then prorate the ownership to determine whether 5 or fewer people own 50% or more of the stock. Now, because it is such a major potential risk to the REIT that if you ever break this 5 or fewer test, if you ever become closely held, all REITs have in their articles of incorporation prohibitions on ownership in excess of 9.8 or 9.9% per person. Obviously, that times 5 is less than 50. Now, there are exceptions. You can carve out certain holders. It's not unusual, for example, for new REITs, newly formed REITs, where the sponsor will own in excess of 15 or 20% of the REIT. Then you simply would ratchet back that 9.8% to some lower figure until the sponsor is able to sell some of the stock in the market or otherwise get rid of the stock.
Now, there are some REITs that follow an UPREIT model. What does that entail?
The UPREIT model is the real estate investment trust, which is the entity that's typically public, or the financing vehicle, will set up a subsidiary called an operating partnership or umbrella partnership, hence the umbrella partnership REIT or UPREIT. That umbrella partnership will own substantially all the assets of the REIT. The REIT will be the majority owner of the stock, or I'm sorry, the partnership interest of that REIT, and then you'll have other interest holders in that partnership. What makes this structure so attractive to REITs and to holders of real estate in total is that you can do a tax-deferred exchange of partnership interests or LLC interests that are held by sponsors of real estate portfolios. You can then contribute those assets or exchange the interest on a tax-deferred basis, allowing REITs to acquire real estate portfolios with their capitals, with their currency, that is, the operating partnership units, and the seller of those units, of the property, does not incur any tax until such time as that seller would then exchange the operating partnership unit for real estate investment trust stock. That exchange is a taxable transaction. However, the stock is typically publicly traded so that the investor, the former real estate owner, can then sell that stock off and meet its tax obligations.
Great. Ken, thank you so much for joining us.
Thank you, Matt.
For more from REITWise 2017, be sure to visit NAREITsREIT.com.